We have Mr. Clayton White here today to talk to us about funding fundamentals, and he's with Simmons & White. He is the founder and a partner. And just to give you a little background on Mr. White, he has over 25 years experience working with startups and early stage companies. And some of his background includes organizational structure and mergers and acquisitions. He has financial management and controls, capital structure, and corporate governance. And he has taken companies through the venture capital process and is currently involved in company valuations, due diligence, planning, capitalization, and exit strategies. Mr. Clayton is also a member and organizer of the South Coast Angel Fund. He has a BS in physics and MBA and is a Juris Doctor, and he's a member of the Louisiana and Alabama Bar. And he sits on many boards for several companies, nonprofits, and community organizations. I just want to let you guys know, thank you so much for being here. Thank you, Mr. White, for being here and doing this presentation for us. How we're going to handle questions is they have the open chat, so you guys can type in your questions throughout the presentation. And at the end of the presentation, we'll go ahead and address and answer all those questions for you. This webinar will be recorded, so once we are finished, I will be able to shoot you over the pre-recorded or the recorded webinar for you to review later or share. And we look forward to getting started. And thank you again, Mr. White, for being here and giving us this presentation. So I'm going to go ahead and turn it over to you.
Okay, thank you very much, Natalie. My name, once again, is Clayton White, and we're going to talk about funding fundamentals and just some basics of different types of funding that's available to companies. And I welcome your questions at the end, and we'll go through them in total. Just some of the companies that I'm involved with. Simmons & White is a business consulting firm. I'm also a lawyer with Louisiana Corporate. We take care of companies all along the Gulf Coast. South Coast Angel Fund invest in startup companies. They're equity investors in early stage companies in Louisiana, Mississippi, and Alabama. And then Network Capital is an alternative lending lender for banks, alternative to banks for lending to companies. So those are some of the companies I'm involved in, and as you can see, we're heavily into dealing with early stage startup and high growth companies. That's our target. So types of funding that are available to companies, broken into 4 different categories: loans, equities, grants, and donations. So the first thing you have to ask yourself, what am I going after? And in order to know that, I need to know what kind of company we are. Are you a high growth company or a lifestyle company? Asset-based company versus a service company, or for-profit or non-profit. High growth may be, give you an example of a real-life high-growth company that was actually started with angel monies, angel investment money, was Google. We all know Google. High-growth company started out in basically a garage, and now it's one of the largest companies in the world, right? That's high growth. A lifestyle company is, I own a single restaurant, and it's giving me a good income, and it'll give me a good income for as long as I want to run it. But in 10 years, I'm going to have one restaurant, and today I have one restaurant. That's a lifestyle company. It supports our lifestyle. Asset-based versus service. An asset-based company is not just a company that has real estate or equipment, but you can also look at software as an asset and so forth. So it doesn't have to be a hard, tangible asset. Versus a service-based company, a law firm, architectural firm, that type of thing, where services are being sold typically on an hourly basis and so forth. And the reason that is important is because the different types of funding will look at the different types of companies. For instance, a service-based company, an architectural company, is typically not ever going to go get an equity investor. Equity investors are looking for high-growth companies that can scale. In order to scale, you need to have a product that can be reproduced over and over again and sell at a high rate without. So I can quadruple sales with and maybe just add 10% more staff to do that, right? So so it's really important to know whether you're an asset-based or versus a service company, and of course a for-profit, a non-profit. Banks a lot of times will only lend to for-profits. Equity investors will only look at for-profits because you can't really own a nonprofit. And so all those things really go into the different factors that will determine whether you are what type of funding you'll be looking for your company. So where do you fit? Grants are great if you're a high-growth company, and especially a technology company, especially if you're doing some kind of medical research or something like that. Grants are available. The great thing about grants is there's no payback, and you're not selling any equity in your company, so you still remain owner of the company, and you have no payback requirements. Grants are very specific in what you have to do to get them, and they're typically pretty hard to get. They're if you're not a nonprofit, they're very, very hard to get, and there's a lot of work that goes up front in getting them. Equity is typically limited to high-growth companies. The great thing about them is there's no loan repayments that have to be made. If the company doesn't succeed, the investor loses right along with you, and everybody goes their different ways and parts ways, and everything's good. The upside or downside, depending on who the equity investor is and how you look at it, is that you pretty much have a partner for the life of the company. And they're going to be there, and they're going to have influence on the company and so forth. And typically, the other downside is that you need to be at least aware of an exit strategy, in that by exit strategy, it typically means you're selling the company at some point. An equity investor will make their money typically when the company is sold, not too much while the company's operating, but when the company's sold. So you need to be aware of exit strategies and actually looking to exit strategies, which kind of runs against the grain of running an ongoing business. With a loan, of course, there's no equity, so an equity being sold, so you don't have a partner. You're more dating than having a partner for life, but you have to pay it back, and so you have to prepare of how you're going to have the cash flow to pay it back. And typically, for companies under, say, $20 million, is going to be personal guarantees involved. So even if the company goes under, they're going to come after you personally. So all those are different things to consider to see where you fit when you're going to look for money, for funding for your company. Just looking at the risk versus return curve, the first thing we see down at the bottom is lines of credit and senior debt. That's going to typically be coming from your traditional bank. That's just where you go to get that. Subordinated and debt with warrants and convertible debt is a little bit higher risk, and then of course you get to the preferred and common stock, which is all equity. So the companies you normally deal with right now for funding, which is 90% of the time would be your traditional bank, they're not going to do the higher risk, higher return type of instruments. They're going to stick to the lines of credits, the senior debt, and that type of stuff. So when we do look at bank financing, you really want to look at matching your loan type to what you need it for. So line of credit is typically for operations and the ups and downs and cash flows, cash flow up and downs of just running your business. Senior debt typically goes on fixed assets, buildings, heavy equipment, fleet of trucks, that type of thing. And those assets that are being purchased are used as security for those debts. So as I said before, the big plus there is you're not giving up any equity in your company, but the really big minus is it has to be paid back, and it's not typically that flexible in the payback, and there's the personal guarantees. Banks will always look to your past cash flow. So if you're a new company, if you're a startup, you don't have past cash flow. So unless you, as the founder of the company, have lots of personal assets to pledge to the loan, you're probably not going to be a good candidate, or the company's not going to be a good candidate for bank financing. You need to have the assets for collateral. That's the two big things that banks look for are, do you have the cash flow to pay back the loan? And if you don't pay back the loan, do you have the assets that I can go seize to get my money back? So this bank financing is typically not the best financing for entrepreneurial companies, for startups or high growth companies. Even if you've been in business for 3 years, if you're a high growth company, your past cash flows probably won't support the need that you have going forward. And that's why they're typically not a good fit. Other sources of loans, though, banks aren't the only sources of loans. Other sources of loans are government-sponsored loans such as SBA and CDBG block grants and so forth. Alternative lenders, there are alternative lenders out there in the market. In this region, there's a group called True Fund. That's what's considered an alternative lender. They have more flexible requirements in that they'll look at your future projected earnings and make a decision off of that, as well as your personal credit rating and so forth. But they don't need the history that a traditional bank will use. And then one thing that you should never forget about is there's loan brokers out there that have access to lots of different funds and capital sources that get very creative about how they do loans. And so depending on what you're doing with this loan, they'll match up sources for you. An example right now is we just closed on a loan where the individual could not go to the bank. He's building a small plant. This is about $5 million. And so we went to a broker, and the broker put together leasing instruments for the equipment that he needed, and married that with some loans for the building, the land, and working capital, and actually worked out to be a very competitive rate. That, along with new market tax credits, he ended up with a rate of just over 5% on the entire $5 million, which is pretty good. And then, of course, there's factoring. If you have receivables, in order to get some money into the company, mostly handling some cash flow things, you can factor. Factoring is when you sell your receivables, right? So normally they'll give you somewhere between 80 and 95% of your receivables today, and then when the receivables come in, when they get paid, they go directly to the factoring company. So that's some different sources of loans other than banks that you can look at for funding your company. What people are going to look at, almost everybody, they're going to look at your credit score, your personal credit score, as well as if you have a DMV report or some sort of credit score for your company. They're going to do a financial analysis on your numbers. In other words, mostly looking at your cash flow. Some groups will do what's called ratio analysis, where they compare the ratio of your different expense items, your gross margin, and then your net margin against other companies similar to you. There's reports that are available to give what's typical. Common sizing just takes those ratios, and now we can look at different size companies in the industry that your company is in, and we can see how your company matches up against other companies in your industry. And then overall balance sheet, profit and loss statement, cash flow statement analysis. These are the basic things that pretty much all lenders will look at. Credit scores are just use of statistical research to come up with a credit score. We typically think of FICO score, which FICO just stands for the Fair Isaac Corporation, who developed the score. The original score, it's been modified many times. FICO scores range between 300 and 850. The median is 720. If you're below 680, you're considered subprime. If you're below 500, you will not get a loan from pretty much anywhere. So making sure you can go check your credit score, you probably want to know that before you go into to ask for a loan. While these are primarily used for consumer and real estate loans, since you're personally signing for a loan on your company, they're going to look at your FICO score also. So you really want to know what that is. The FICO scores and most lenders look at your payment history, which your credit history, how much is already owed, the length of your credit history, how much new credit you have available. So if you have credit card offers or credit cards out there that you have a zero balance on, but $10,000, $20,000 limits, that's new credit that's available. And what's the mix of your credit? If it's mostly a mortgage on property, that's not going to be, the negatives there aren't going to be weighed as much as, say, a poor credit card history. Just like FICO scores for individuals, businesses have credit scores also, and typically which uses Equifax risk ratings and credit grades, also Moody's, and there's several other rating services out there for larger companies. So then we get into what's called mezzanine, the convertible debt and subordinated debt with warrants, and it's called mezzanine because it's kind of in between straight lending and straight equity, right? So it's a higher risk. It's usually a high growth company that can't really go get the funding that they need through a bank, right? So it's also higher risk because it's subordinated to all the bank, to most of the bank senior debt, so it's a higher risk to the lender. The lender typically takes low-cost warrants. Warrants are the instruments that give them the ability to purchase equity in your company, right? So low-cost warrants just means they have warrants that they don't have to pay much to get the equity. They're getting this equity in return as one of the kickers for giving you the loan, right? Remember, these are higher risk loans. So the purpose here is for high growth companies that are already producing revenue. Mezzanine financing is not for pre-revenue startup companies. They want to fund growth, or in some cases they can allow the owner to take some of the equity, the cash out of the business. So they're basically buying equity from the owner that owns 100% and allows the owner to take money out of the company. They do carry a higher rate of interest, whereas a bank loan today may be somewhere between 4 and 7%. These are typically in the 9 to 15% range. They may or may not require personal guarantee. Most of the time they do not. And like I said earlier, warrants allow the lender to take an equity stake in the company sometime in the future. And these are typically, mezzanine financing resources are typically access that you typically find out about them through loan brokers and or knowledgeable sources like your CPAs, your lawyers, and so forth will have typically have access to mezzanine financing sources. And then, of course, we get into straight equity, the common and preferred stock. This is more when you're getting into angel and venture capital. So they're no longer a lender, they're an investor in your company. They purchase equity in your company, so they become an owner in the company. And I will tell you that some venture groups are referred to as vulture groups. They want to take a majority ownership in your company. Good ones typically will not. To give you an example, South Coast Angel Fund, the company that invests in Louisiana, Mississippi, and Alabama early stage companies, looks to take between a 15 and 25% equity stake in the company. They're not looking to take over the company. In fact, that would be a failure scenario for them to take over a company. So they're no longer looking at cash flow to repay. They're looking for an increase in company value. So they're not betting on the cash flow. They're betting on the opportunity, right? And the entrepreneur, the founder's own ability to execute the business. And these are very high risk because if the company goes away, if the entrepreneur can't execute, if the market just does away with the company, if there's too much competition, there's so many things that can go wrong. If something goes wrong, the investor loses their money. So as a result, they're looking for a fairly high payoff, which is the reason they look for high growth companies that have the ability to give them their high payout. When you're looking at equity funding, this is a chart that kind of gives us a layout of the sources for equity funding. So we start out on the left. It's a smaller demand for money, usually 25 to 100,000 when the company's first starting. This is called the pre-seed round, and it's usually put up by the founders themselves, or the 3 F's that are listed there are usually referred to as friends, family, or fools, right? Because they're investing in high-risk, early-stage companies. The next would be angels. Angels play anywhere from a range of about $75,000 investment up to several $1,000,000 of investment. This is typically when the company is going through a development phase. Let's use software for an example. We have to develop the software. We have to get it ready for market. We have to look at our support strategies and our distribution strategies. And guess what? We're going to be spending money, and we don't have any revenue coming in. And that's what the yellow and black lines are there for. That's called the funding gap, and it's usually referred to as the valley of death, because if a company can't get funding for this time frame, it dies. There's no way for it to go forward. So that's normally where angels and venture groups come in. Venture groups are on the larger side. They're usually minimum 2 million up to 50, 60 million, and even above sometime. So they play after the company has proven the model, has some sales, and now needs money to grow, whereas angels are typically getting the money into the company to make it viable. So that's equity investing, and this is just a repeat of what I just said. Angels fund early stage companies up to about $1 million, sometimes even as high as 2. Ventures as low as 2, but typically 5 and up. Typically accessed through their website or through knowledgeable sources, once again, attorneys, CPAs, and so forth. Something I need to point out, if you're interested in equity funding, all equity funding is regulated by the SEC. It's not just Coca-Cola that's regulated and large companies like that you fund on the stock market. Anytime you're selling equity in a company, there are SEC regulations that you need to be aware of, and therefore you should be going to a lawyer who is knowledgeable in those rules. So once again, we get back to where do you fit, and you have to go through this analysis of what you're looking for, what type of company you are, and figure out where you fit and what type of funding source you need to go to. It does no good to go to equity sources if you're not a high-growth company. It just doesn't. It also does no good to go to a bank if you're starting up your company or you started it up yesterday and you don't have lots of personal assets. So see where you match and go to those sources that you match well with, and you'll be much more likely to get the funding than not. And that's it. That's the funding fundamentals that we go through. If anybody has any questions, you can type them in, or I don't know, Natalie, I don't know if they can speak their questions or not, but
I can unmute everyone, but I would prefer if everybody could type their message in the chat window, just so it'll cut down on background noise. Does anybody have any questions? I mean, it could be, you know, related to what he was talking about, or if it's other funding questions.
Yeah, these were the fundamentals, but we get into fairly advanced stuff also. Without knowing the who is going to be on, we stuck with the fundamentals just to get the conversation started. So if you have an example of what type of funding you may be looking at or why you're looking for funding, we can address that and maybe answer some questions that way. Okay.
All right. Well, I don't think anybody has any. Oh, here we go. Easy locations of grant sources. Oh, wait.
Hey.
Hey, this is Richard.
It's Rich. I type slow. I'm sorry. I pulled my back.
All right.
So I'm trying to lean over. So my question, and it's probably a goofy one, I apologize if it is, but of course, being a governmental entity, our sources, our grants obviously come from other larger governmental entities or,
sure. Grants.gov, right?
But, to help developers, as all cities and try to do, is there, I know there's got to be thousands of sources, but are there some basic sources of where developers or somebody that might have a good idea that can identify sources, whether it's for adding a recreational piece to a subdivision they have planned, or for an assisted living project, that there may be some funding to just enhance their development, not necessarily help them construct it, because there's not a whole lot of money for that, of course, because it's going to come from private sources and investors, obviously. But, is there for maybe extra things that a developer might like to consider that might enhance their project and gain maybe better support from the local community? Sorry for my goofy question.
It's not a goofy question. So you're talking about a developer putting in some additional features such as playground or that type of thing for whatever the neighborhood is developing, he or she is developing. So
or landscaping, that kind of thing.
Sure. So quality of life type.
That's exactly what I was thinking of. You're correct.
Right. So the big issue here is that you're talking about a developer and therefore probably a for-profit company, which for-profit companies are greatly limited in where they can go get grants. Now, if that developer wants to set up a nonprofit and donate that land to the nonprofit and then go get a grant to develop whatever they're going to develop, that opens up several different ways to go after grants. And there's I mean, you could just do a Google search on that for nonprofits and quality of life grants. There's not one source to go to for that, so I would just say Google it. But I will tell you that if the developer is trying to do it through his development company, it's a challenge. Most granting sources, other than the government or even local, state, the federal government for sure, most granting sources other than the government will only grant to a nonprofit. And even then, most of them are limited to 501c3s, right? Most people think of 501c3s when they think of nonprofits, but there's actually about 27 different types of nonprofits, some of which can get, you can write off your donation and some of which you can't. So the typical one that we think of is a 501c3. So the easiest way to do that, and it's not easy, the easiest way to do that is set up a nonprofit, donate the playground or whatever you're doing to the nonprofit, or at least assign it the nonprofit rights so that the nonprofit can go get the grant. But it would be difficult for the developer to get a grant for that directly. Did I beat around you?
Sorry, go ahead.
That's all right. I didn't want to make sure.
Well, yeah, but I mean, I didn't know if there was, other than Googling, is there other? Of course, you got the Renaissance Foundation. I know they're limited on what they do, and is there like a listing of foundations or sources or a catalog, if you will? I know this sounds crazy. From everything from the Ford Foundation to whatever else. You used to see this goofy guy, I forgot his name, on TV with a bunch of question marks all over his suit, different colored question marks. It would come on those late night shows that unfortunately I'd watch as a teenager and young adult. And he was always up in D.C. carrying this big book around that was, he'd come on and say, you want to find grants, you want to find information, well, here it is. And he'd have this big book that had a big question mark on it and say, you send me $59.99 and, here you can find answers to your potential grant monies. You remember that
Sure.
guy that was on TV?
Yeah, and he was directing you to grants.gov, which is the government, federal government's grant website, and it's not just government grants on there. It's all kind of groups from the Ford Foundation on down that you can find grants on grants.gov, which is a good central site to go to. Most of the grant portals are specific to types of grants or purposes for grants. There are several organizations. The National Association of Nonprofits has a portal to go to search for grants. I'll tell you, the hardest part about it is not finding potential grants. The two hardest parts of it are getting the nonprofit status right now. Ever since the controversy with the IRS and the Tea Party nonprofits, it is now where it used to take 3 to 6 months to get your nonprofit status approved. We are now pushing on 2 years to get it done. So getting your nonprofit status and then applying for the loan, for the grant, is the two hard parts. And typically, groups will limit you from applying until you have your nonprofit status. They won't do it on the fact that you've applied for nonprofit. You have to have the nonprofit. So, and with the IRS taking so long right now, it's usually it's a less than optimal way to go right now. We have companies that are literally pushing on 2 years and they still don't have their nonprofit status. They haven't gotten refusal. It just hasn't been fully processed by the IRS yet. So it's very difficult to get nonprofit status, and it's very, very difficult to get grants other than government grants if you are not a nonprofit.
Okay. Well, I appreciate it. It's a very nice presentation, and I certainly appreciate being invited.
Good question.
Okay, so we have another question. This is one of the people in the calls asking, they're saying they have an opportunity to get matching funds from NSF for one of their NSF funded projects. What is the process to potentially get some funds from South Coast Angel Fund?
South Coast Angel Fund and most angel groups are going to look at, it still needs to be a high growth company. They're still going to have their normal criteria for a company, high growth company in an area where they have some expertise within the fund. That's a requirement. So for two reasons, most angel groups want to have some expertise in the industry so that they can do a good analysis of the company, do their due diligence, but also most angel groups don't want to just put money in. They want to be able to help the company grow. So high growth company in their target area, and a company that they would have some expertise, not expertise enough to do the company, but some expertise that they can offer to the company to help it grow. So yeah, I mean, but that's a good carrot to be hanging out if there's matching funds available and it's been applied for. That's a great carrot for equity investors, South Coast Angel Fund, and any other angel groups. There's, there's groups in Mississippi, there's groups in Alabama, there's groups in Louisiana that invest along the Gulf Coast and or in the 3 states. They're not necessarily just in the Gulf Coast, but yeah, that would certainly be something they'd look at, right? Any type of incentive that would enhance their investment would be a good thing.
Excellent. What about franchises? If someone wanted to open a franchise, do angel funds ever invest in franchise depending on location or type of franchise, or is it mostly just startup?
It's a possibility if it's the franchising company, but not the individual franchise. No, that would be considered a lifestyle business, yeah. Okay. So you can look at it almost like if you were opening up, well, I'll use Cane's Chicken, right? Because that's a southern entrepreneur that did that. The corporation Cane's Chicken would be a good investment, but an individual storefront would not be.
Right. Okay. Excellent. Well, does anyone else have any other questions? No? All right, you guys. Well, we appreciate you being on the call today. And, of course, Mr. Clayton, thank you so much for giving us your time and expertise.
Thank you.
And if anyone has any other questions, I'm sure we can get you in touch with Mr. Clayton should you have any other private questions you want to discuss. So thank you so much. And, again, as soon as we get this recorded version up, we'll shoot that over to you as well.
All right. Thank you very much.
Thanks,
Thank you.
Natalie.
Y'all have a great day. Thanks.